So are we about to take that next leg higher?
I think so, and it's going to be led by a fairly diverse cross-section of industry groups and sectors, and I like that action. This is not going to be the FANG stocks and then everything else trailing behind, which is what we had seen at previous highs that ended up not being very sustainable. I think this is a very different picture. I'm sure Stephanie would agree. Look at what's working right now. I'm looking right now at financials. The XLF has spent the last few weeks hanging near highs, stopped making forward progress, but gave absolutely nothing back. No sellers, especially in the big ones like JP Morgan, which, full disclosure, I am long and have been long for a while. That's a super bullish setup for next week. You can't say it isn't. And when financials are doing well, historically, stock markets do well, especially when they're at record highs. You look at REITs right now, about to make another all-time high, unbelievable. The last one I wanted to throw out, which we don't really talk about that much on the air, and I understand why, but the All-Country World Index ex-US. Let's pull this ETF up. It's ACWX. This is the entire global stock market with no U.S. stocks in it, right? Not only are we approaching an all-time high right now, but actually, over the last 12 months, this index has outperformed the S&P 500, which I don't think a lot of people are even aware of. But go down the list and look at these huge stock markets overseas, in Europe, in Japan. They're actually having the same reflationary trends that we are coming out of this pandemic. And when the whole world seems to want to break out, it's really hard to stay bearish or to stay pessimistic. So I think that's the way I'm looking at the current environment.
All right. I mean, Steph, it does feel, to Josh's point, that risk-on sentiment has returned, even in small increments. That's what Mike Santoli's been looking at, and we talked to him earlier this week on this program. Do you agree with Josh and that overall sentiment? You can look at small caps, been up 5 of the last 6 days as well. The big FANG stocks have finally started moving again. There are a lot of things that are starting to work again.
Yeah, I mean, this has been the year of rotation, right? I mean, value has outperformed growth by a big margin year to date. But in the last 2 weeks, Scott, I think it's been interesting to see growth make a comeback. And I think the reason is because some people are fearing that we're seeing peak economic growth and that there's no inflation whatsoever. And in that scenario, growth would do better than value. I don't subscribe to that. I think given all this stimulus that has been put in place for the last 14 months, and more to come, by the way, is going to lead to strong growth. Maybe not as strong as first and second quarter that we expect, but it's going to stay above trend. And I think, look, I cite PMIs and ISMs all the time. How about that Chicago PMI number? Best number in 37 years. It beat the street by 8 points. I mean, that is just astounding to me. And then you got the Richmond Fed earlier this week talking about CapEx spending up about 42%. So if you get a CapEx cycle on top of the momentum we're seeing in manufacturing, that is a good sign. And then we are still seeing good trends in the consumer. Yesterday's GDP number, you had a revision on the personal consumption. So my point is growth is still there. It's going to stay strong. I do think there's also some inflation in the systems that is real. Wages are real, and they're going up. People can't find people to work, and they're paying up for those people of what they can find. So if you have a bit better growth, a little bit better on inflation, that is a recipe for owning more cyclicals, more value-centric companies. And you want to have a barbell, though, too. You do want to have a little bit of diversification and secular growth. So I'm still sticking with my strategy.
All right. Hey, how about this for a statement? Jason Snipe buying more Twilio and Shopify. I mean, if that doesn't say something, I don't know what does. You tell us about that.
Yeah, no doubt, Scott. So for me, I mean, our playbook hasn't changed for the most part. I mean, it's obviously been a cyclical and value play since the beginning of January. But, we have begun to start to nibble at some of these high beta, high multiple stocks. Twilio, it's just got a great secular story, just a seamless way of they're able to communicate with their customers. Shopify, I mean, just the support that they have around, small businesses and medium-sized businesses. Obviously, these are very expensive stocks, with For example, Shopify trading at 94 times, 46 times sales. But I think there's opportunities here, and there might be some short-term pain, as Steph kind of described the macro backdrop, but I think there's opportunity here in the long term, and that's why we've started to nibble more.
I'm just saying, if you thought the market was about to fall out of bed, you're not buying more Twilio, you're not buying more Shopify. I mean, if you thought rates were going to run away from us, you're not buying more Twilio and you're not buying more Shopify.
You got it 100%. Even when I think about talking about tapering, we're starting to take the training wheels off, because the market the economy is really strengthening. This is positive news. This is good for the economy. So for me, we decided to take an opportunity and start to look at some of the high beta names that have gotten beaten up some over the last couple quarters.